Good Tuesday morning from Hong Kong. It's 9 a.m. here in the city, up in Beijing and in Shanghai. Welcome to Bloomberg Markets China Open. I'm David Ingles with Yvonne Man.
Our top stories this morning: Asian stocks edging higher after moderate gains on Wall Street. Investors recalibrating interest rate forecasts, with the Fed standing firm on its 2% inflation goal. Provincial debt, a new pressure point for China's economy, with most regional governments now facing a serious funding squeeze.
And I'm Haslina Amin, live at the Aviation Festival in Singapore. We're speaking to some of the biggest names in the sector about the headwinds facing the travel recovery. This hour, we speak exclusively with HK Express CEO Mandy Ang.
Oh, yes. Where is this sort of revenge traveling going here in Hong Kong? Also, maybe we expected to hear some news on the whole mask mandate as well. A lot of local media talking a little bit about that. But Dave, we are wrapping up what looks to be, what a turbulent month, really, for February.
Yeah, this re-rating and this repricing of Fed expectations.
Yeah.
I mean, we kicked off Feb with that very strong jobs report. And since then, it's been uphill on yields. It's been downhill, really, on equity markets. I think we're down 4 weeks on equity markets. It's what, the worst Feb for
onshore and offshore RMB.
Yeah, there we go.
Ever.
Okay.
Yeah.
Not a lot of love, as they say. Equity markets, though, as we wrap up this turbulent month, a little bit higher there, as you can see there on your screens. We should be looking at about 5% losses, 5.5%, give or take here for Feb. Support levels, bottom of your screens on Hang Seng Index. We're about halfway through the earnings season, which we'll get to in just a moment. Data points today, you have Thai trade numbers. Oh, by the way, in case you missed it, Hong Kong trade exports fell the most in 70 years yesterday. The budget's coming out, and of course, this hour, as Yvonne was alluding to, it's that weekly briefing from John Lee. Is it mask off, mask on, or is it something for another conversation, another day? 142 in dollar yen is a target of Morgan Stanley. They entered that trade 136, stop loss at 132. And we're also looking at a couple of key superlatives here as far as currencies are concerned. There you go with the yuan, 8% up on dollar Korea. Very briefly, 2, 5, 10s, and 30s. Yes, in case you're falling asleep this month, we are substantially higher than we started Feb. And a quick glance at commodity markets, and B of A will be coming on in about 10 minutes or so to talk us through the China plays as far as their assumptions on the reopening and this recovery is concerned. Glance at some of your contracts there on your screens.
Yep, we'll take a look at, of course, more Fed speak. A top Fed official has pushed back against a growing view that the central bank should move away from its 2% inflation target. Let's get to Kathleen Hayes, our global economics and policy editor. She's joining us with the latest. And what more did Philip Jefferson say, Kathleen?
Philip Jefferson, who is one of the newer members at the Board of Governors, he took office in May of, I'm going to check that again. Anyway, May of last year. But this is important because I think people always wonder when someone's new, what do they stand for? What are they going to push for? He was teaching a class in economics at Harvard today. Wouldn't you be a lucky student to be there? And somebody brought up the issue of people are talking about the Fed maybe moving the target up, changing it from 2% to something higher. And of course, there's been an argument out there that, well, you know, you can't fix supply chains with higher interest rates. You can't get people back into the office with higher interest rates. So you're going to bash the economy with all these interest rate hikes. You're not going to necessarily fix inflation, and that's going to be a mistake. Let's listen to how Philip Jefferson looks at that.
I am committed to lowering inflation to our 2% target. Changing the FOMC's longer run inflation objective, however, would introduce an additional risk by calling into question the FOMC's commitment to stabilizing inflation at any level, because it might lead people to suspect that the target could be changed opportunistically in the future.
This is so important. Inflation expectations, if your central bank says, well, we have to meet 2%, and they say, well, I guess we don't, then are people going to be convinced that you really mean it? Are they going to change their behavior, their expectations? Are they just going to expect ever higher rates, et cetera? He did say, as a matter of fact, he sees some chance that services may finally start cooling off more, and that could help bring down inflation. Of course, that's a big problem because, again, with tight labor markets, with a strong economy, people spending money, they're still getting higher wages. They're still helping to push final demand up. and that's the thing that works against it coming down. And there you see the numbers. And I think also, you guys, when you see how far it is between the target and how high all those lines and bars are, that's another reason people say maybe you just need to move it up, at least temporarily. I don't think this debate's going away, but it doesn't look like it's picking up a lot of steam at the Federal Reserve yet.
Kathleen, BOJ, there's an official in New York insisting that you look at the target at 2%. Although we are about double the level currently, that they haven't met that target just yet. What's the nuance?
Well, this is so interesting to me. Wasasumi Wakatabe, deputy governor, who his last day at the BOJ is on May 19th. He's put in his 5 years. At this event at the Center on Japanese Business and Economy, he spoke for, a good 40 minutes, and he talked about all kinds of things about the economy and inflation and BOJ, and he did say more than once that they haven't reached their 2% target. So there was a little bit of Q&A at the end. So I took the opportunity to say, hey, I'm showing you this chart because my question is this. You can see all these different inflation rates. The purple one is 4.3. That's the main number, okay? That's the purple one. Anyway, just go down the line. We'll forget the colors. The next one is 4.3, okay? That's where you take out fresh food. Okay, now if you take out fresh food and energy, you get down to 3.2. But the one that really fascinates me is if you take all food out, like the Fed does, and all energy out, like the Fed does, that rate, whatever you want to call it, core, is 1.9. Now, as I said to him, this is a rounding error. That's 2%. Why can't you say you're at 2%? And are you worried that if you keep going, you're going to make the same kind of mistake that the Fed did, where they thought transitory inflation was here to stay, and they didn't move fast enough? Anyway, listen to how Mr. Wakatabe answered my question.
We don't want to repeat the mistakes the Fed and ECB did in sort of preempting the surge in inflation. But also, I have to say that we don't want to make the past mistakes of the BOJ or premature sort of tightening before the inflation took hold at the 2% target level.
One of the classic examples of the BOJ tightening too soon has come out as we all been trying to figure out, Mr. Ueda, who's on tap to become the next BOJ governor. Remember, because he was at the board from 98 to 2005. In 2000, the Bank of Japan, even when the economy was not strong, decided it was time to raise the interest rate. He voted against it. Only Mr. Ueda and one other board member. They were right. At the time, he said it wasn't that he didn't necessarily think they needed to, but he didn't have enough data. I think that's the kind of mistake that Mr. Wakatabe is referring to, and that seems to me that part of their history maybe is a little more in front of everybody as they try to figure out, gee, when do we have to start normalizing, and is it time to do so?
Kathleen Hazer, Global Economics and Policy Editor there. Staying on the BOJ, we're just getting some lines coming through out of the BOJ's Deputy Governor, the nominee here, Shinichi Uchida. He's speaking at the Diet here, just talking about how the BOJ's task, I guess to Kathleen's point, is to mull how it will continue easing and I guess ways to make that sustainable, I guess is the point there. And that easing has affected market functioning in banks, I guess mirroring really what the governor nominee or to be had to say a few days
after
ago.
2 days of facing lawmakers, you have the deputies now speaking. You have Himono-san also speaking in Parliament right now, talking about deep analysis, responding flexibly, vital when it comes to policies. They're still staying pretty flexible here, it seems, at this point, but still leaning a little bit more on that dovish side. And more to a Bloomberg scoop now. We've been following this in the last few minutes or so. Our sources saying that China Evergrande has yet to reach an agreement with major creditors on a debt restructuring framework. Let's bring in Alice Huang, our China credit reporter, who broke this story. And what is the situation going on right now?
Yeah, as you were saying, Yvonne, I'm afraid there's very little progress, any meaningful, substantial progress or update, and that is what's daunting because, as our headline were suggesting, Evergrande is facing quite a few big dates for itself. So it has the March 20th hearing that is coming up, but more importantly, last time at the hearing in November, it told the judge that it would get creditor support by late February or early March. And today is the last day of February. Early March is coming up. And some may say, Evergrande has postponed this thing over and over again. What's different this time? Exactly because it had already adjourned, is winding up hearing so many times. The judge last time actually urged it to please come up with something concrete to show at the March hearing, and that is coming up, and still there is no progress to be shown. So I think that could be particularly worrying for investors.
What is slowing down these negotiations? I mean, it's been a while since this story has started, and yet we haven't even come full circle just yet, really.
Yeah, really. Like, there's only very little detail that we know so far. And based on what sources tell us, it seems there are a few key areas of disagreement. So you may recall that my colleague Jackie, she wrote last time that the plan that Evergrande has proposed to creditors involve two parts, and one of them includes a debt-to-equity swap option.
Yep.
So now there are conflicts apparently over the valuation of those equity of the shares of Evergrande itself and of its units. Also, the creditors seem to have asked for Evergrande's entirety, like stake, the entire stake in this unit, whereas the company itself is only willing to give so much.
They have a court hearing next month on the 20th. What happens if Evergrande actually loses this lawsuit?
Yeah, well, it has seen as developer peers like Yango and Cynic got wound up. So what will happen if it loses this lawsuit is it could get wound up. It can get a winding up order by the court, and then the court can appoint a liquidator. It can come in, seize its assets, and sell them, and use those funds to pay creditors.
All right, Alice, great scoop there. Alice Wong, they're bringing us the latest when it comes to Evergrande, our China credit reporter. Let's get to the first word news. We have Vonnie Quinn in New York. Hey, Vonnie.
Hey, Yvonne. Thank you and good morning. The UK and European Union have reached a new deal on Northern Ireland's trading arrangements. It paves the way for warmer relations more than half a decade after Britain's voted for Brexit. UK Prime Minister Rishi Sunak says the deal, known as the Windsor Framework, streamlines Northern Ireland's unique access to both the UK and EU markets.
For as long as the people of Northern Ireland continue to support their businesses, having privileged access to the EU market, and if we want to avoid a hard border between Northern Ireland and Ireland, as we all do, then there will be some role for EU law.
U.S. Treasury Secretary Janet Yellen says Washington will support Ukraine's economy for as long as it takes against Russia's invasion. Speaking during a visit to Kyiv, Yellen said U.S. aid will help sustain public services, including education and healthcare. She also praised the Ukrainian government's efforts to fight corruption to ensure foreign funds are used responsibly. Hong Kong may scrap its mask mandate as soon as early March. Sources tell Bloomberg both indoor and outdoor masking requirements may be removed at the same time. Face coverings will still be needed at high-risk places, including hospitals. Compulsory masking began almost 3 years ago and has lingered even as the city launches a glitzy tourism campaign and tries to portray itself as open for business. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Vonnie Quinn, and this is Bloomberg. Yvonne.
All right, plenty more to come. Let's get to what's up in the air right now. Yvonne Man is at the Aviation Festival Asia in Singapore with a busy day of big interviews.
Well, cautious optimism among airline officials here. Later this hour, I'll be speaking to the CEO of HK Express, Mandy Ang, one of the few women who've successfully climbed to the top of the aviation industry's corporate ladder. We'll get her outlook for travel in the Asia-Pacific region.
All right, that is coming up in about 30 minutes from now. Before that, though, lots of good conversations. BofA comes on. Their head of China equity research. We're talking commodities and the commodities angle with them. And of course, also this lithium investigation story. Later this hour, Goldman Sachs chief on equity strategist Kindra Lau comes on too to talk us through their own respective plays. And of course,
we're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. We're still on sort of bear market watch when it comes to HS Tech. You're seeing pretty similar sort of moves when it comes to the Nasdaq Golden Dragon overnight as well. Futures, though, slightly positive this morning. This is Bloomberg Markets, China Open. Good morning.
All right, welcome back to shows here. The yuan fix is out for the day. That's the currency offshore. Fix is bottom of your screens, and we are poised for the worst ever February both onshore and offshore, really down to this dollar repricing that's taken place.
Yeah, we're about, close to 3% losses for February. It's certainly one to watch here as we approach that 7 handle once again. Also, a lot of regulatory sort of risks that we're following as well, particularly when it comes to now the lithium industry that we saw yesterday. As you know, the top production hub faces sweeping closures amid a government investigation into environmental infringements. Now, we're talking about Yuzhong in Jiangxi province, delivering around 1/10 of global supply that could be impacted now.
Yeah, let's get a sense of what this means for prices moving forward, particularly given the fact that lithium has screamed higher and then almost come, I think it's down 20-30%, if not mistaken. Matty Zhao is here with us, co-head of China Equity Research at BofA. She also heads their Asia Pacific Basic Materials, Oil and Gas Research. She's a very busy person, so we thank her for making her time to come here. So let's start with lithium. Just your broad thoughts on where prices go from here, particularly given the latest development.
Yeah, sure. So Yizhuang is the biggest producing areas in China and also one of the most importantly in the global as well. It accounts for around 10% of global capacity. So far, we still don't know how long this suspension will take place. Last year, we had a similar investigation and it took around 2 weeks. So just assuming if it's take a similar time, then I think the impact will be relatively limited. Our view on the lithium is we still think it's an oversupply market this year. We are expecting a 38% increase in the supply globally and a 20% demand increase this year. So we are expecting lithium prices to continue to drop probably to about 350 or 300 level by the end of this quarter and then before it gets stabilized into second quarter. So I think investors can wait a little bit.
What's behind that call? Is it more that EV demand is going to slow dramatically this year? I mean, last year, obviously, there was a crazy year when it comes to lithium.
Yes. So we saw lithium prices hike from 50,000 to 600,000 at the late last year. One of the reasons is because of the strong EV growth. Last year, China EV growth was 95%. This year, we are forecasting the EV growth to slow down to around 20%. So from a demand perspective, that's one of the biggest driver on the slowdown. And on the supply perspective, we are also seeing a lot of the new projects got delayed in the past 2 years will come out this year. Of course, if this Yizhuang situation lasts longer than last time, and this may cause some of the stabilization on the lithium prices.
Okay, let's look at a broader picture. You're positive on what now as far as materials go, and what are you less positive on?
Sure. We are most positive on the copper and on the aluminum sides, and we are also selective positive on cements. We are relatively cautious on paper. We downgraded the paper into underperform, and we are cautious on some of the energy names, especially like coal.
Why? I mean, everyone's tracking this China reopening story. Why copper? Why aluminum?
Sure. So we think this China reopening is more of a consumption-led China recovery, demand recovery. And at the same time, we are also positive on the infrastructure investment as well. We are expecting the infrastructure investment to go up by 10%. And specifically, power grids, we are expecting power grids demand to go up by about 10% as well. And this will be beneficiary for copper and aluminum because 40% of copper demand come from power grids. And a 10% growth, obviously, is very beneficiary to that. Also, we expect property market to be less bad this year as well. Our house expect property completion to go up by about 10% this year. Last year was a negative 15%. And we are also expecting property new start to have a smaller drop this year compared to the negative 40% last year. So copper and aluminum has around 30% of their demand exposed to property completion. And of course, 40% of copper come from grids as well. So that's why we are expecting copper and aluminum to have a 4% demand growth this year compared to a flat last year. At the same time, on the supply perspective, we see aluminum supply got largely affected recently in China. So China accounts for 58% of global aluminum production. And because of power shortage, we are actually seeing Yunnan, Guizhou, Sichuan has a long suspension of aluminum, at least until May to come back. So that affects about 5 to 7% of China capacity, or around 3% of global capacity. So on the one hand, you have demand go up, and on the other hand, you have a capacity suspension. So those were the reasons that we were positive. I think the last point is about coal. We have been very positive on coal in the past 2 years, but we saw coal prices more than double in the past 2 years as well. We are seeing historical high production in China. China production went up by 9%. We are seeing historical high inventory in China as well. And then now this China reopenings means that the coal inventories will have a faster destocking happens, which means we are expecting coal prices to decline. So this will benefit the midstream, especially like aluminum. They're very sensitive to coal prices. So that's one of the reasons that we are positive on.
What about cement and steel? I mean, you talked a little bit already about cement. Just take us through the thinking on cement, and I'm not sure if you cover steel too.
Yes, I cover cement and steel as well.
Yeah, let's hit it.
For cement, we are selective positive. We are more positive on the East cement play. We are expecting cement demand to stabilize. Last year, cement demand was down 10%, and this year we expect to be about 1% up. Thanks to, of course, a much lower property new starts drop. And at the same time, we are expecting infrastructure to go up as well, infrastructure investments. That's why the cement demand will be more stabilized. And also, if we look at coal is 40% of cement's cost. And obviously, a 20% decline in coal prices will also help that the cement margin recovery.
Yeah, all right. We're going to leave it there. Maddie Zhao, thank you so much. Great stuff. Co-head of China Equity Research at BofA. We got plenty more ahead. This is Bloomberg. All right, taking a look at some stocks to watch at the open. Lithium stocks, very much given what we saw over in the U.S. session late yesterday on the back of this whole lithium probe in China as well. We're not seeing a whole lot of movement, but certainly you're seeing Kuaishou down some 1.7%. You have this kind of line about China considering ways to curb excessive video use when it comes to short video. So Kuaishou, Bilibili, Tencent, the like here, watching Xingyi Solar as well. That's down 1.5% after we saw net income miss estimates there.
Okay, and that takes us into, I mean, a lot of this also goes down to some of the biggest drags as we wrap up this month. And as you can see, the year started out good and basically just went downhill from there. So we're now close to 17% down from the peak, and we get to 20. That's a technical bull market. But yeah, Goldman Sachs will be coming on in a couple of minutes to talk us through their thinking of how you take advantage of this information as we speak.
Yep, they're still thinking, 20% upside from what we saw just a few days ago. But here's what in terms of analyst actions. Heidi Lau raised to buy at UOB with a price target of $21.20, and to Sports raised to buy at UOB. A shares also of GF Securities cut to neutral at CITIC.
Okay, a couple of things to watch in the next 20 minutes or so. It's the weekly briefing of Hong Kong Chief Executive John Lee. Will he, won't he talk about this mask? Speculation certainly out there. The Open is next. This is Bloomberg. Okay, here we go. Last one. Can you believe it? It's March, right? We're moving into month 3 of 2023. We have a nice story out on the Bloomberg talking about how it's March Madness here in Hong Kong with just a ton of events marking this return to the global spotlight of Hong Kong. The question is, will visitors be mask on or mask off?
Ooh, or indoor, outdoor, right? There's a lot of questions on whether they do lift it or not.
Yeah.
What this means, but certainly that's the one thing, the last sort of thing that's remaining out of COVID here that everyone's kind of pinning their hopes on.
Yeah.
So we'll see that press conference happening about 10 or 20 minutes or so. In terms of the open, this is the approach here right now. You are seeing still some green arrows on the board here. 0.4% higher for your A50 futures. Hong Kong's doing slightly better. And really yesterday, there was a lot of risk-off moves here on the back of just the Fed repricing, the like here. But it's pretty slow going today. Not a whole lot of news flow on that front as well. But you take a look at Shanghai, we're up 0.4%. Shenzhen's doing a little bit better, but we're wrapping up Hong Kong as the milestones are getting worse, right? So you have HSI that enter into a correction.
Yeah, following others.
Everyone else. We're watching HS Tech now as Dave had mentioned, getting ever so close to that 4,000 level. But really, we could be talking about bear market territory. Nasdaq Golden Dragon certainly is approaching those levels as well. Dollar renminbi, 696.19 for your offshore right now. So we're talking about the worst ever set to be February drop for dollar for China, I should say, for renminbi. Ever. So certainly one to watch in terms of the dollar moves are concerned. Shanghai crude slightly lower here. Really, the bulls in oil not able to kind of capture this reopening story still. Watching the lithium sort of exposed stocks like cattle, Goshen, high tech here. Still seeing a decent day here on the back of some of these probes that we've been hearing about when it comes to lithium in China as well. Li Auto earnings that came out, we're seeing a 3% drop. Despite the forecast for the first quarter, it was quite rosy as well and beating expectations. They're expecting 52,000 to 55,000 vehicle deliveries now. BYD as well. Clarifying a little bit some local reports about price cuts. They're saying no official price cuts. Could just be some distributors' promotional sort of sales here that they're discounting here right now. Watching very much Kuaishou, 2% lower here. China considering maybe ways to curb excessive video use. So we're talking about short videos, which would really mean anything from games, TikTok, ByteDance, Douyin, the like here. So we're focusing very much on some of these names. Bilibili down also 2%, Dave.
We should clarify, screen time is not Bloomberg, so spend as much time as you want on us. We get you guys the good stuff. We've come full circle in MSCI China as we wrap up this month here. So good January, and as you can see, we've just about given up almost everything. But we'll see where we go from here. We're at 66 right now. Joining us here on set, Kinjer Lau, Goldman Sachs Chief China Equity Strategist. You guys think we're up, what, 20% from current levels? Yep. What's behind the bullishness? Well,
as you show in the chart, it seems like we're having some sort of profit-taking, consolidation or correction, whatever you want to name it, since really the Chinese New Year break, right? But don't forget that the market rallied 60% from the lows in late October all the way just before the Chinese New Year holidays. So from a valuation perspective, at the lows, we were trading at 8 times PE. And at the peak, we were back up to about 12 times. So that rally was mainly driven by valuation expansion or normalization. But going forward, our target may seem a little bit aggressive, but I think it's pretty reasonable if earnings growth can come through. So what we are talking about here is that when valuations are now back to sort of reasonable levels, we need earnings growth or earnings delivery to drive further gains for Chinese equities. And on that basis, we're still looking for about 17% EPS growth for China this year, which is a little bit above consensus.
Yeah. Where will those upgrades be coming from? What sectors are you focusing on this time?
Well, I would say a couple of things. Number one, clearly consumption or consumer-related sectors. Given the low base that we had in 2022 because of the COVID distractions or disruptions, I think we will likely see pretty meaningful recovery in top-line growth as well as margin sort of recovery for consumer-related sectors. Besides that, TMT, again, from a low base, and given the regulatory environment seems to be turning a little bit more positive, we think that should bode well for TMT companies' earnings.
What are your expectations on the multiple? Where do you think that multiple goes with your target on price?
Our target PE is 12 times. Okay. So right now we're trading at about 10.5. So again, just 3 weeks ago, we were at 12 times.
Yeah.
Right? So at that point, we were very close to what we think is the fair valuations for Chinese equities. Now has come back down a little bit, so we still expect some moderate upside on multiples. But again, the key driver will be earnings.
What's going to wake up this market again? Are you looking at MPC as another catalyst? I mean, people, we had BofA yesterday saying don't expect these big cash vouchers and the like to really boost consumption. But what are you expecting out of these two sessions?
Well, last week we held a very big conference in Hong Kong. 4,000 investors came and joined us. And for sure, two sessions definitely in focus. Everyone asking what's our expectation on that. Now, bottom line here, we don't expect a lot, right? There's not like big bang sort of stimulus coming out from the conference. But some clarity about growth policy, I think, will be important, especially when now talking about a new administration in the government, right? So the new premier, vice premiers, I think clearly the signal that we'll get from the two sessions will be key to watch. And on top of that, I think the upcoming macro data releases will be getting a lot of attention from investors because from mid-March we'll likely get all the combined January and February macro data points.
Yep.
I think that will likely show some confirmation that we are moving to the right direction in terms of recovery.
Back to the earnings theme that I think is the premise really of your report here. We're moving into the thick of earnings season. Have you heard anything? What's Oh, wait, sorry. Some breaking news.
We have to interrupt you,
You will like
Kinjer.
this too, Kinjer.
Hong Kong to end mandatory mask wearing starting March 1st. All right.
Okay.
Woo, we
All
have
right.
cheers in the control room, guys.
All right.
I'm
All right, even Kinjer.
We're finally clapping
All right,
our hands.
明天没有了.
Yes, we are focusing on these live pictures
Okay.
coming out of Hong Kong here right now. The chief executive, John Lee, speaking and making that big announcement here. Obviously, we've been talking about all these big events happening here. So starting tomorrow.
Yeah. Mask off March. Let's call it that. Okay. Live pictures right now. This is the weekly press briefing of the Hong Kong chief executive. So, yeah, they
They're still
did
wearing
it.
the masks, though. I mean, we still got one more day.
Yeah.
Yeah.
Okay. Have you heard anything so far? Anyway, do you have any reaction, Kinjer? Anything so far as mask
Pretty
go?
well expected, and we are
Yeah?
ahead of the government. No mask here in the
Yeah.
studio.
Oh, yeah. Okay. Well, let's turn it back then. I guess in a lot of ways, this is almost the last restriction to be removed, really. And Hong Kong was the last sort of place in the world where you did have to wear a mask. Where are we now on this? Where are we with the reopening story? I guess. What are we looking forward to as far as data is concerned, for example? What will convince you that you will get that earnings follow through?
Well, the story that we've been telling investors over the past month is that I think investors should start to move on or move away from sort of just focusing on reopening and focus a little bit more on the recovery potential, because it's not just
because it's reopened already.
Yeah,
Okay.
because I mean, as we all know, China is more or less back to normal, given all the mobility data that we track, and now Hong Kong mask off, so it's back to normal. So I think really what's important in terms of equity market expectation here is, again, earnings. Now, to your point or your question, David, I think the upcoming results season will be very important.
Yeah.
And on our estimate, we think first quarter will be okay, but the sweet spot is really in the second quarter, where we expect GDP growth to print like 10% sequential Q1Q annualized sort of momentum.
How are you looking at regulatory risks now? Obviously, there's been news about tech dealers or tech bankers that are being investigated or ongoing or taking part in the investigations. You have talks about limiting youths and video use and all that. Should I forget about the regulatory risks for this year?
I think you talk about some sort of idiosyncratic incidents, but at the high level, we have our proprietary indicator to sort of get a sense of where we are in the regulatory tightening cycle. And that indicator suggests that we are actually in a sort of easing territory at the moment, which is quite consistent with the developments regarding online gaming approvals and fintech companies getting restructured and things like that. So I would say, again, the story that we are pitching here is that we are transitioning from what we call as an announcements phase of the regulatory tightening cycle into an implementation stage where we'll likely get more clarity and transparency about regulations, so that companies will be in a better position to adjust themselves and to sort of navigate the new regulatory environment. And I think investors as well will be in a better position to price the impact on regulations on earnings as well as on valuations.
Very quickly, a final question. How do you discount what the Fed's doing? Because Hong Kong's obviously not immune to what's happening, or Hong Kong and China's not immune to what's happening there.
Well, clearly, the Fed repricing is a headwind to equity valuations, but don't forget that we are trading at very low valuations for Hong Kong equities. So I think the sensitivity, the rate sensitivity to Fed rate hikes should be less significant than what we had in the past episodes.
Okay,
cool.
Kinjer, thanks so much for joining us. Kinjer Lau, Goldman Sachs Chief China Equity Strategist, sharing all the good news here in Hong Kong with us as we celebrate.
A little bit of a giggle, too.
Kind of big news here. So mask mandate starting Wednesday. Gone. We're not quite sure what the specifics are, but certainly they're saying owners of certain premises can still require masks. So I think it's up to these owners of these certain places and locations, but certainly we're watching very closely. You're seeing a little bit about market reaction. Cathay Pacific extending the gains as much as 1.6%. You have Sasa International, which sells those masks as well, mind you, though, but up 4.6% on the back of this big announcement ending that mask mandate here in Hong Kong. We're watching things like China Yuhua Education as well. That stock spiking here after resuming trade, too.
The world's longest mask mandate, 945 days.
Oof. You've been crunching the numbers, haven't you?
No nose.
You've been marking it every day.
The Excel file closes today. There we go.
Hey, I think I'll still wear mine. Public transport, maybe.
Yeah.
Yeah, you know?
Still good to be cautious.
But, you know, it's optics, right? And what this really signals, right? Hong Kong really trying to make this sort of mark that they are ending these kind of last restrictions of COVID. They're ready to open up. A lot of big, bankers and visitors coming through here now. We have big events coming up. So certainly it's all about the optics there. Cathay Pacific, look at that, 1.3%. This is Bloomberg. Just kidding. We're going to Vonnie Quinn.
Yeah, gotcha.
Our news, Vonnie. Take it away.
Well, it is Bloomberg, and it's a celebratory moment, so congratulations, guys. Meanwhile, Fed Governor Philip Jefferson is warning against changing the central bank's 2% inflation target. He believes that altering it could destabilize what he called well-anchored inflation expectations and call into question the central bank's commitment to its goals.
I am committed to lowering inflation to our 2% target. Changing the FOMC's longer-run inflation objective, however, would introduce an additional risk by calling into question the FOMC's commitment to stabilizing inflation at any level, because it might lead people to suspect that the target could be changed opportunistically in the future.
Adani Group executives are said to have emphasized the company's ability to generate cash. Investors taking part in its Asia Roadshow told Bloomberg the group said it has enough money to repay debt maturing over the next 3 years with an $800 million credit facility. The events in Singapore and Hong Kong mark Adani's latest effort to reassure investors following the Hindenburg report fallout. Hong Kong exports even plunged in January by the most in 70 years, affected by an early Lunar New Year and waning global and mainland Chinese demand. Overseas shipment fell by almost 37%, while imports fell by around 30% from a year ago. Financial Secretary Paul Chan said slower economic growth will continue, though the end of border disruptions should ease some of the pressure. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Vonnie Quinn, and this is Bloomberg. Yvonne.
Vonnie, coming up, the CEO of Hong Kong Express, Mandy Ng, gives us her post-pandemic travel outlook for the APAC region. Maybe get her kind of take on this whole mask mandate ending as well here in the city. This is Bloomberg.
All right, in case you missed it, the breaking news in the last 10 minutes or so, Hong Kong has announced the end to the mask mandate. 945 days, the world's longest, effective tomorrow. That mask mandate is dropped. There are some details, though, and a little bit more, I think, as far as this is concerned. But the headline certainly just reads itself. Market reaction, as you can see there on.
Yeah, certainly seeing Cathay Pacific up some 1.5%. Let's talk a little bit more about aviation and bring you back to Singapore. And Linda, you have our next guest.
Well, Vaughn, no more reasons not to fly to Hong Kong. Let's bring in Mandy Ng, CEO of HK Express. Mandy, good to have you with us. We're just saying about how Hong Kong's mask mandate will be dropped from 1st March. How much of a boost do you think that will give to the passenger numbers?
I think this is definitely the most welcomed news to us, not only for us being in Hong Kong, living in Hong Kong, but also for us running the airline to welcome more travelers coming from the rest of the world to rediscover Hong Kong in a very natural way without any masks, and so that they can see each other and also see the welcoming smile from all the Hong Kong people.
How strong has the recovery story been for HK Express? Because if you take a look at the numbers from the Hong Kong airport, they said it's seen a surge of 2,900% in terms of passenger numbers. Is that what you're seeing as well?
I think for us, being the only LCC in Hong Kong, we were small, but our recovery path actually went a bit ahead of the curve. back in September last year when Hong Kong first announced relaxing all the travel restrictions. At that time, we were only about 10% of our 2019 levels. But now, as of now, we're talking, we're back to 80%. And by end of March, we expect ourselves to be back to 100%. So anything from March onwards, we're talking about growth for our airlines.
A lot of the story, of course, hinges on China's reopening. In terms of the numbers from China, what are you seeing?
We see a pretty strong demand from travelers from China, in particular from the Greater Bay Area. They are actually booking their tickets well ahead of the borders reopening. And for us, HK Express, we also are working very closely with our partners, try to explore new ways to welcome all these travelers coming from GBA. For example, we actually launched our Air Plus Ferry Pass product so that travelers from GBA can actually check in and check their bags when they are on board the ferry and then collect our flights to different destinations.
Can you quantify the outbound numbers for China and what kind of growth are you anticipating? When are you expecting pre-pandemic levels as well?
I think we already seen a growth ahead of pre-pandemic level. Having said that, that's for us because it's HK Express before pandemic. We just started to actually grow this market, and now we see the benefits of the reopening, and we see very active booking behavior from the travel populations in China, in particular GBA.
Mandy, in terms of ticket prices, we've seen an escalation of about 25% from a year ago. I'm just wondering whether you think ticket prices will remain elevated. In my conversation with Tony Fernandez, he said, yes, it should have been the case since 2019 because of higher costs that airlines incur, but the AAPA says they will normalize.
I think Tony and other airliners will agree with me that airfares is a reflection of the market demand, definitely. And to what I've just mentioned, as we recover from the pandemic, we see lots of pent-up travel demand and lots of our flights actually of very high booking levels. So we expect this reflection of the market demand will continue. And also at the same time, we do have some observation about people more willing and place more value for airfares that will take you direct from point A to point B. And for example, for us, we serve a lot of what people call secondary destination, like going to Japan other than Tokyo or Osaka. We also fly to smaller airports, which people can take direct flights, and the demand for those services also overwhelming. So we hope that we can continue to bring the best service to our customers, and I'm sure they will be very pleased to have the chance to rediscover, the world and different destinations.
Even as we talk about a recovery for the aviation sector, there are lots of headwinds, including surging jet fuel prices, the geopolitics coming to the fray as well, along with a slowing global growth. I'm just wondering, how are you navigating all those challenges?
I must say, for us, we are quite lucky to have Hong Kong as our home base. As we see Hong Kong reopens and also China reopens, Hong Kong continues to play a very strategic role as a gateway to going into China. And also we, as I've just mentioned, we are actually seeing lots of travel demands coming from our extended home market, the Greater Bay Area, which is talking about 86 million of populations. So I guess that, yes, there are challenges, but the opportunities actually outweigh all these challenges.
We know that the pandemic decimated pretty much the aviation sector. What's the key lesson learned?
Well, there are a few things. First of all, I think for our people, we learn to be more resilient. We manage our business in a more agile way. Also, we're willing to challenge status quo because we have to challenge status quo. We have to face all these changes. So that means we also have the mentality to fail fast and learn fast. That's one thing. And the second thing is I can see that many businesses, also including the airline business, have seen accelerated growth in terms of their digital journey and also their data propositions. I think that's a real plus for all of us.
All right. On a positive note there, Mandy, thank you so much for that. Mandy Ang, CEO of HK Express, and we're coming to you live from the Aviation Festival here in the Lion City. Great news for you folks in Hong Kong. No more mask wearing come March 1st. Dave, Vaughn?
Yeah.
Perfect timing, too, to get married to respond to all this, right? It's like we teed it up perfectly. All right, We've got plenty more ahead. This is Bloomberg.
Okay, welcome back. Some of these reopening names in focus on the back of this announcement, formal, official, final announcement that Hong Kong will be ending the mask mandate starting tomorrow.
Yep, after 945 days, right? Our colleagues have kind of crunched the numbers for us. So certainly good news here. You're seeing some of these Hong Kong reopening stocks flying here, like Cathay Pacific up 1.5%, Sasa's up close to 6%. The health secretary saying Hong Kong fully returns to normal. We're watching also another stock, China Yuhua Education, really spiking here, some close to 30% as trading resumed. They've been shut for a few weeks now, and watching Xinyi Energy, some of these solar names as well. Their earnings certainly was a miss here when it comes to net income. But overall, market's looking pretty good right now, Dave.
Yep, as we wrap up really what's been a challenging month, so maybe a bright spot going into the Ides of March. There's plenty more heads here in shows. This is Bloomberg.